Imagine waking up every morning knowing that your bills are already taken care of. Not because you worked a long day at a 9-to-5 job, but because your investments are paying you. Feels like a dream, right? Well, what if I told you this dream could actually come true in 2025? Yes, it's possible, and today I'm going to share the fastest strategy to make it happen. Stick with me, and let's turn this dream into your reality. We're going to make this dream a reality by focusing on dividends, and with the right strategy, these dividends can grow into a steady income stream, covering your expenses and giving you financial freedom. Let's dive in. Alright, let's first understand what dividends are. Dividends are like a reward companies give to their shareholders. When a company makes a profit, instead of keeping it all, they share a portion of it with the people who own their stock. Think of it as getting a slice of the company's success just for being an investor. For example, imagine you own shares of a company like Coca-Cola. If Coca-Cola makes a profit and decides to pay a dividend of $1 per share and you own 100 shares, you'd get $100 in dividends just for holding those shares. It's that simple. Now that you know what dividends are, here's the exciting part. We're going to break down the steps you can follow to build a portfolio that pays you enough dividends to cover all your monthly expenses. For example, let's say your monthly expenses are $2,000. If you invest in companies that pay a 4% annual dividend, you'd need a portfolio worth $600,000 to generate that $2,000 every month. Don't worry, it's not as impossible as it sounds. With the right strategy, you can grow your investments faster than you think. Let's get into how it's done. Step 1. Define your goal. Let's talk about the first step, defining your goal. This is where you figure out how much money you need to live comfortably every year. Start by jotting down your monthly expenses, things like rent, groceries, utilities, and even a little extra for fun. Then multiply that by 12 to get your annual number. For example, let's say you spend about $3,000 a month. That means you'd need $36,000 a year. Now here's where the math comes in. If you're targeting a 4% dividend yield, which is pretty common for good dividend-paying stocks, you'd need to invest around $900,000 to make that $36,000 a year. I know, $900,000 sounds like a huge number, but don't let that scare you. We're going to break it down step by step so it feels less overwhelming. Remember, the key is to focus on progress, not perfection. Let's keep moving. Step 2. Build the foundation. Now that you've defined your goal, it's time to build the foundation for your dividend income. The next key step is maximizing your savings rate. The more you save, the more you can invest, and the faster your dividends will start rolling in. Think about it this way. If you're able to save 50% of your income, you're essentially doubling your investment power. For example, let's say you earn $4,000 a month and you're able to save $2,000. That means in just 1 year you'll have $24,000 to invest. The faster you save, the quicker you can grow your investments, and with that, your dividend income. It's all about consistency and making saving a habit. The more you focus on putting aside a bigger chunk of your income, the sooner you'll see your investments start working for you. Let's move on to the next step. Step 3. Identify high-yield stocks. Now that you've got your savings in order, it's time to start investing. The key here is to focus on high-yield stocks. These are companies that pay 5%, 6%, or even 8% in dividends. The higher the yield, the more money you'll make from your investments without having to sell your shares. But don't just pick any high-yield stock. Look for established companies with a solid track record of paying consistent dividends. Companies in industries like utilities, real estate, or telecommunications are great options. These businesses are stable, often paying dividends regularly, and have been around long enough to show they can weather economic ups and downs. For example, think of a company like Verizon. They have a strong history of paying dividends and are part of a stable industry. By investing in companies like these, you're setting yourself up for reliable, growing dividend income. Step 4. Use dividend ETFs. Next up, let's talk about dividend ETFs. These are like bundles of high-yield dividend-paying stocks, which give you instant diversification, meaning you're not putting all your eggs in one basket. The benefit? It helps reduce risk because you're spreading your investment across different companies and industries. One great option to look into is Vanguard's High Dividend Yield ETF, VYM. It's a collection of companies known for their strong, consistent dividend payouts. By investing in this ETF, you're able to own a piece of many dividend-paying companies without having to pick individual stocks yourself. This makes it easier for you to build a reliable, diversified dividend income stream without as much risk. Dividend ETFs are a smart way to get exposure to multiple companies, all while keeping things simple and less risky. Step 5. Reinvest your dividends. Here's where the magic happens. Reinvest your dividends. Every time you receive a dividend payout, don't cash it out. Instead, reinvest every single penny. This strategy allows your dividends to buy more shares of the companies you're interested in, which in turn earn you more dividends. For example, let's say you receive $100 in dividends from your investments. Instead of spending it, you use that $100 to buy more shares. The next time those shares pay dividends, you'll earn a bit more than before because you own more shares now. Over time, this creates a compounding loop where your money starts growing faster and faster. Reinvesting your dividends is one of the most powerful tools for building wealth through stocks. It might seem small at first, but trust me, the longer you do it, the bigger the snowball gets. Step 6. Use tax-advantaged accounts. The next step is to make your investments even more powerful by using tax-advantaged accounts like IRAs or 401ks. These accounts allow you to keep more of your earnings by lowering or even eliminating the taxes you'd normally pay on dividends. For example, in a Roth IRA, any dividends you earn grow tax-free, and you don't have to pay taxes when you withdraw them. With a 401k, your dividends are tax-deferred, meaning you don't pay taxes on them until you withdraw the money, usually when you're in a lower tax bracket. By using these accounts, you're keeping more of your dividends working for you instead of giving a chunk away in taxes. This helps your investments grow faster and lets you build up that dividend income much more efficiently. It's a win-win. Step 7. Diversify globally. Finally, let's talk about diversifying internationally. While U.S. companies offer great dividends, many strong, reliable companies outside the U.S. also pay solid dividends. By investing globally, you're adding a layer of stability to your portfolio. For example, companies in Europe or Asia may offer higher yields or more consistent payouts, especially in industries like energy, healthcare, or consumer goods. This international diversification helps protect your investments from market swings in any one country and can lead to more opportunities for growth. Think about it like spreading your risk across multiple countries. The more countries you invest in, the more chances you have to earn steady dividend income from different parts of the world. It's a smart way to reduce risk while boosting your dividend income potential. But avoid the pitfalls. While diving into dividends, there are a few important pitfalls to avoid. First, don't chase the highest yields without checking if they're sustainable. A huge dividend yield might look tempting, but if a company is paying out more than it can afford, it could cut or even eliminate dividends down the line. Always check the payout ratio. This shows what percentage of earnings is paid out as dividends. A safe payout ratio is usually below 70%. Anything higher could be a red flag. Next, don't forget to diversify. Putting all your money into a single stock or industry is risky. What if that company faces trouble? Or what if one sector crashes? You want to spread your investments across different industries and countries to reduce risk. By avoiding these mistakes, you can ensure your dividend strategy remains solid and reliable, helping you achieve financial freedom faster. Imagine you start with $100,000 in 2025 and invest in a portfolio with an average 5% yield. That's $5,000 in annual dividends right off the bat. But here's where the magic happens. If you reinvest those dividends instead of cashing them out, and also add $1,000 a month to your investments, your money will start working even harder for you. Over time, those dividends buy more shares, which in turn earn you even more dividends. This can double your dividend income within just a few years. It's like a snowball effect. You start small, but as time goes on, your income grows faster and faster. It's that powerful. You're not just relying on your initial investment, you're building a growing, self-sustaining income stream. Living off dividends isn't just for the wealthy, it's for anyone who has a plan and the discipline to stick with it. The best part? You can start today, and by 2025, you'll be that much closer to financial freedom. So take action now, follow the steps we've covered, and watch how your investments grow. If you found this video helpful, make sure to hit subscribe for more strategies on how to grow your wealth faster. Keep pushing forward, and I'll see you in the next video.